Hi, welcome to the channel. Let me ask you this. Have you ever stopped to wonder how banks know when something suspicious is happening with your money? Imagine swiping your card in another city, and within seconds, your bank sends you a message asking if it was really you. That's not luck, that's advanced fraud detection systems working behind the scenes. These digital protectors are constantly scanning millions of transactions, spotting the tiny red flags that most of us would never notice. In today's video, we're going to break down how these systems actually work, how they stop criminals before they get to your money, and why understanding this matters for your financial safety. Here's what we'll be covering in this video, so you walk away with a complete picture of fraud detection, what fraud detection actually is, and why it's so important for your money and businesses, the different types of fraud, where the data comes from, what information banks and companies use to spot unusual behavior, how that data is prepared, cleaned, organized, and made useful for spotting threats, how detection really works in action, the step-by-step process of catching fraud before it hurts you, how fraud detection stays strong in the long run, constantly learning and adapting to outsmart evolving criminals. By the end of this video, you'll know exactly how these invisible defenders keep your money safe and why understanding their role is key to your financial security. Chapter 1. What is fraud detection system? A fraud detection system is an organized set of tools and processes that helps financial institutions spot, prevent, and alert users about unauthorized or suspicious activities, whether online or offline. These systems use advanced data analytics, artificial intelligence, and behavioral monitoring to reduce losses and protect individuals and businesses from fraudsters. Fraud detection is a key pillar for banks, e-commerce, insurance, and many companies handling sensitive financial data. Its effectiveness relies on real-time analysis and timely response, helping minimize financial damage and boost trust in the institution. Chapter 2. Types of financial fraud. Financial fraud commonly falls into several categories. 1. Identity theft. When a criminal gains access to personal details, social security, or bank credentials, and impersonates the victim to commit fraud, such as taking loans or transferring money without consent. Imagine this. Sarah gets an email that looks like it's from her bank. Without realizing it's fake, she clicks the link and types in her login details. A criminal now has her bank username and password. The next day, Sarah wakes up to see that a loan was taken out in her name and money has been transferred to an account she doesn't recognize. She didn't approve any of this, but because the fraudster had her personal details, the system thought it was really her. 2. Payment and card fraud. Unauthorized use of bank cards via theft, card cloning, or skimming devices that copy details during legitimate transactions. Example: Alex pays at a gas station, not knowing there's a skimming device on the card reader. Later, a criminal uses the copied card details to make online purchases, while Alex still has the real card in his wallet. 3. Account takeover fraud. Fraudsters obtain a victim's login credentials using phishing or malware, take control of accounts, and transfer funds or make purchases. Imagine this. Maria clicks a fake email that looks like it's from her bank and unknowingly gives away her login details. A fraudster logs into her account, changes the password, and transfers money out, locking Maria out of her own account. 4. Advanced fee scams. Victims are promised big returns or funds but first asked for upfront processing fees. Example: an email claims the victim won a lottery and needs to pay administration charges to receive the prize. After paying, the fraudster vanishes. 5. Investment and Ponzi schemes. Fraudsters offer enticing investment opportunities with unrealistically high returns, using funds from new investors to pay old ones instead of investing in real ventures. Example: get 30% return in 30 days. Investors pour in money which is never invested. Instead, it's cycled to give initial payouts until the scheme collapses. 6. Phishing. Trick users into revealing passwords, OTPs, or bank details via fake emails, websites, or SMS that look legitimate. Example: an email that appears from a bank asks for login details due to suspicious activity but is actually a scam site. 7. Credit card and debit card fraud. Fraudsters make fake cards using stolen card information or conduct unauthorized purchases. Example: Data breached from a retailer is used to make counterfeit cards for shopping sprees. 8. Loan scams. Fake lenders offer quick loans with high interest and predatory fees, trapping borrowers. Example: apps advertise instant loans, require large upfront fees, and then disappear after collecting money. 9. Insurance fraud. Fraudulent claims filed for events that never happened or exaggerate real losses. Example: claiming theft of unknown jewelry or staging car crashes for insurance payouts. 10. Business and corporate fraud. Misreporting financial statements, input tax credit frauds, or using ghost employees. Example: a firm fakes expenses or inflates revenues to qualify for loans. 11. Romance, recruitment, and lottery scams. Fraudsters use fake online dating profiles, job opportunities, or lottery wins to convince victims to send money. Example: an online admirer urgently requests money for a family emergency, or a company asks for money for job processing. 12. Consumer and retail fraud. Counterfeit products, refund scams, and fake websites that never deliver goods. Example: shopping sites offer huge discounts, take payment, but never ship any products. Each of these fraud types exploits human trust and system vulnerabilities. Fraud detection systems aim to catch such activities early, using patterns, alerts, and smart algorithms to protect financial stability and customer safety. Chapter 3. Where the data comes from. Data collection and aggregation in a fraud detection system means gathering information from many different sources and combining it in one place so it can be easily checked for suspicious activity. Imagine Sarah shops online. Each time she pays, the store records, what she bought, when she paid, how much she spent, which device she used, phone or laptop, where she ordered from. Now, Sarah also visits ATMs, uses mobile apps, and gets email alerts from her bank. Each of these actions creates more ATM withdrawals, mobile logins, email notifications, and more. All this information is collected from different channels, websites, apps, ATMs, and customer service calls, and sent to the bank's fraud detection system. Suppose Sarah usually shops at her local grocery store every week and withdraws money from an ATM near her home. That's her normal data pattern. One day, there's a big credit card payment from a new city and an ATM withdrawal late at night in another country. The fraud detection system collects data about location of each transaction, time and amount spent, device or method used, was it Sarah's phone, usual shopping and withdrawal habits. By putting all this information together, aggregation, the system can spot if something seems odd, like two transactions far apart at the same time. Sarah's bank can alert her instantly if it notices this unusual activity. Why is aggregation important? Data aggregation is like piecing together a puzzle. Looking at only one piece doesn't reveal much, but when Sarah's transaction data, device data, and location history are combined, it becomes easier to spot signs of fraud quickly and accurately. Chapter 4. What is data processing and fraud detection? Data processing means cleaning, organizing, and preparing raw data so that the fraud detection system can actually understand and use it. Raw data often has errors, duplicates, or messy details, so it needs to be fixed before analysis. Example: think about Sarah's transactions. Her bank records. One entry says $50, another says $50 US, another says paid $50. All three mean the same thing, but they're written differently. If the system doesn't process this data, it might treat them as separate or confusing entries. So, the fraud detection system processes the data by standardizing it, converting all to $50.00, removing duplicates, filling missing details like device type or location, structuring it in the same format. Once the data is neat and consistent, the system can compare Sarah's spending patterns more accurately and spot unusual activity much faster. In short, data processing is like tidying up a messy room. Once everything is in order, it's easier to find what doesn't belong. Chapter 5. How fraud detection works. Fraud detection systems don't just look at one transaction, they compare it against patterns, rules, and past behavior to decide if it's normal or suspicious. They use a mix of techniques like rules-based checks, machine learning models, and real-time monitoring. Example: Let's take Sarah again. She usually shops near her home in New York, spends around $50 to $100 at a time, uses her phone for most payments. One night, the system sees a $1,500 purchase in London using her card. Here's how detection works step by step. Rules check. The system flags it because the amount is way higher than her usual spending. Pattern analysis. It notices Sarah never shops outside the US. Device check. The payment came from a laptop, but Sarah usually uses her phone. Risk scoring. Combining all this, the system assigns a high risk score. Action. The bank sends Sarah an instant alert or temporarily blocks the payment until she confirms it. Response. If Sarah replies no, the payment stays blocked and her card may be frozen. If she replies yes, the bank allows the transaction to go through. Chapter 6. How fraud detection stays strong. In long run, criminals keep changing their tricks, so fraud detection systems need to keep learning and improving. They do this by analyzing new fraud cases, updating rules, and training AI models so they don't fall for the same scam twice. Example. Last year, fraudsters tricked people by making tiny test charges, like $1 or $2, to see if a stolen card worked before making bigger purchases. At first, some systems missed it because the amounts looked normal. But once banks spotted this pattern, they updated their fraud detection rules. Now, even very small unusual charges in strange places, like $1 at a gas station across the world, can trigger an alert. Conclusion. That's how fraud detection works, from collecting data and preparing it, to spotting suspicious activity in real time and staying sharp against new tricks. These invisible systems are working every day to keep your money safe. If you found this explanation clear and helpful, don't forget to like the video, subscribe to the channel, and hit the bell icon so you never miss out on more easy breakdowns of financial topics that matter to you.